All right. Thank you very much for joining us today, everyone, and for being here on time. As always, we'll give it a couple more minutes while we wait for some folks to come in. So, if you're joining during your lunchtime, go grab that cup of coffee or fill up your water cup, whatever you need to do, or run to the bathroom really quickly. But we'll start in about call it 90 seconds. Awesome. So we'll go ahead and get started now. And as those other folks trickle in, they'll get to join the party with us. So thanks for joining today's webinar, which is the Overlooked Infrastructure Opportunity, Investing in America's Schools with Bob Hellman. I'll turn things over to Bob in just a moment. But first, we got to do our mandatory disclosure to make the lawyers happy. So as always, this webinar is for educational purposes only. Camoplan does not provide investment advice or tax advice, so if you are going to make any investment or tax decisions, please do your due diligence and use the counsel from the correct professionals, advisors, tax attorneys, etc. Also, a housekeeping item, we'll have the chat feature turned off on the webinar today, but you could ask your questions and you're encouraged to ask your questions through the Q&A function. So it's always better when we get a lot of questions to make this more of a dialogue. I will be watching that and sharing them with Bob. So please find that Q&A function and don't be shy. Ask your questions during the presentation. And then lastly, if you have any questions about the webinar afterwards that don't get asked or just questions about self-direction, please reach out to me at mmore@camoplan.com, or you can use that phone number too. So Bob, without further ado, you are up, sir.
Appreciate that, Matt. Thank you very much, and thanks everybody for joining us today. I love to start off by simply saying good morning or afternoon, depending upon where in the country you are. But appreciate the interest, and especially appreciate the interest in trying to work with us to try to address the needs of America's school buildings. This is an area in which we have been working now for over a dozen years, and is an area that really needs some love and attention, while at the same time presenting very interesting and attractive investment opportunities. The school room that you see in front of you here is actually from a school that we acquired and modernized in our first fund, but I'm jumping ahead. American Infrastructure Partners is a company that we started back in 2006 with the simple objective of trying to fix our country's infrastructure here in the United States. You can put that under the heading that somebody's got to fix this mess. We do so by building the kind of discrete platforms that you see on this page. We're going to talk a lot about schools, this third platform over here today. But in addition to that, we have separate teams of people and separate funds dedicated to other areas in this country. So, there are 120,000 broken bridges in America that need to get replaced. We have a 40-person dedicated team and a $972 million fund that focuses on just building, owning, and operating replacement bridges, toll bridges. That $972 million fund owns today 6 bridges and operates a 7th on behalf of a city. And our CEO is in Washington, D.C. this week, meeting with people at the Department of Transportation about the next package of bridges. The second of these columns that you see here focuses on the simple problem that the largest distribution company in the world is not Amazon, it's not Alibaba, it's not Federal Express, it's the U.S. Post Office. And the U.S. Post Office operates and relies upon a collection of some 32,000 facilities across the country, which you and I would call post offices, three-quarters of which are actually owned and leased to the U.S. government, owned by a collection, a highly fragmented group of some 12,000 individual owners, and the average owner is 78 years old. So you have the largest distribution company in the world, the second largest division of the U.S. government, relying upon a collection of facilities owned by a highly fragmented group of older folks in this country. Fairly dysfunctional. Historically, that meant that the Postal Service did not have a real estate partner. We have raised and have been actively deploying a $570 million fund with a dedicated 29-person team who eat, sleep, and breathe post offices. We own over 1,000 post offices today as we speak, and we have become the real estate partner for the USPS. And I was in Washington last week meeting with senior officials there on a couple more needs that they have in the real estate area out across the country. But let's dive into the challenge of America's schools. This is the fourth largest category of underfunded infrastructure in the United States. So we're talking about the public schools of America, the K through 12 education in the U.S. For children ages 5 to 18. They are educated in facilities across the country. About 7% of those children are educated in private schools where mom and dad pays the tuition. The other 93% in public schools where the education is funded by state government. There are some 95,000 of these public schools across the country, and on average, they're 50 years old. The American Society of Civil Engineers estimates that the amount of deferred maintenance on these facilities is over $420 billion. So it's a big problem across the country, distributed in small pieces in cities all across America. And therefore, that's one of the challenges here is it's tough to get at when it's $10 million here and $5 million there and $18 million there. But what we recognized as we were researching this area of need in our country is that the underlying funding of the operations of the schools is in pretty good shape. I'm speaking to you today from Silicon Valley. I live in California. Here in California this year, the state of California will pay over $24,000 per child for primary basic education, K through 12 education. That money funds teacher salaries, school supplies, rent on facilities, and administration, the running of the school. In California, they actually, according to the state constitution, have to pay to educate the kids before they can pay interest on state general obligation bonds, which means that our rent is paid in funding that comes ahead of the creditors. In other states, it's pari passu with debt, but in every case, it is the primary funding priority for every state in the country. So you have this interesting dichotomy of well-funded operations in facilities that in many cases are literally falling apart. That's the problem we recognized going all the way back to 2013. And as a result of that, we created school infrastructure partners. In our first go-round, we deployed $369 million. We acquired and modernized 43 schools. And that resulted in a net return for that pool of capital of over 15% net to investors with quarterly cash yield, because we were acquiring schools that were up and operating and paying rent, with quarterly cash yield that rose from 8% at its onset to 10% by the end of the life of the fund. The school that you see pictured here in Fort Mojave, Arizona, sits adjacent to one of the tribal nations, an Indian reservation down there in the greater Phoenix area. This school needed a lot of work. It's a K through 8 school that needed a new roof, needed some classroom capacity, needed a new HVAC upgrade. Typically, the schools that we acquire and modernize need certainly HVAC systems, technology package, security perimeter, and beyond that, like this one here, may need some other things as well. Now, once we finish modernizing a school, and I'll show you the economics of an individual school investment in a minute, But once we finish modernizing a school, we end up with a very attractive asset. It's paying us rent, typically in the 8 to 9.5% cash on cash range. We have a 20-year lease with a couple of 10-year extensions, typically with inflation-linked annual escalators in rent. It's a very attractive asset, but they're small in aggregate investment size. The average investment that we make in a school is $10 million. As we were going along, executing on this fund and doing our work, it takes us about 2 years to modernize a school. Typically, we own a school in total for 4 years. We began to think about liquidity on our investments, and we began to sell schools off to private REITs, public REITs, and other private real estate buyers because they are very attractive assets. State-funded rent, essential service to a community, pretty attractive thing to own. And we were getting nice returns. We were selling schools in the 7.5% cap rate range. So we were getting, hitting a lot of singles and doubles, which is an attractive overall strategy, but not exactly what I would call compelling on the exit side. Now, in the United States, we have this unique form of financing, which are called tax-free municipal bonds. Many of you, I'm sure, own them in your portfolios. And tax-free bonds can be issued by state governments and a variety of different types of local governments. In fact, we often found we were competing in a city that needed an upgrade of a school. We were competing with the concept that they could go get a supermajority vote of their taxpayers, issue their own bonds, and do it themselves, even though in many cases they'd never built a school in decades, so they weren't sure how to manage that process. As we began to look at that form of financing as potentially competitive to what we were doing, we also saw an operation for that to be collaborative. Because in our research, we realized there's a third type of entity that can issue tax-free municipal bonds, that being public charities. As a result of that, we set up a tax-free charity called Wonderful Foundations. You can look up information about them right at the bottom at this web address here at the bottom of this page, wonderfulfoundations.org. And their mission as a public charity is to own education facilities for the long-term benefit of children and communities. To give you a sense as to how this works in our investment strategy, in 2020, we were in the process of seeking liquidity on a portfolio of 11 schools, 11 of these 43 schools that we had initially acquired and modernized. And we had a package of 11 schools. We had a very attractive offer on those schools that in aggregate was about $142 million. Wonderful Foundation had just received their tax certification, their certification from the IRS that they were good to go as a public charity. And I picked up the phone and called the chairman of that foundation, Troy Snyder. I said, Troy, we have a package of 11 schools we're getting ready to sell to a couple of sophisticated real estate investors. Seems like this is now would be a time for you to think about executing on your mission. And he said, good call. Thank you for your call. Give me just a minute. He picked up the phone and called our friends at Citibank, who were at the time the largest distributor of tax-free municipal bonds in the United States. Citi took a package of over 2,000 pages of information on those 11 schools, conducted a 2-week roadshow, and came back to Troy and said, your offering of these bonds is some 19 times oversubscribed. They're wildly popular, and we can give you $190.2 million for those schools. Now, sometimes I'm accused of not being super good at math, but I do know that 190 is more than 142. And Wonderful Foundations acquired those schools from us and today own those schools on a long-term basis. If I stopped my story here, you would say to me, well, it sounds like you've created an opportunity to find a tax-free entity that will pay more for your schools, and that would be true. In fact, because Wonderful Foundations is a public charity, tax-free, financing acquisition of schools with 100% tax-free debt, They have a cost of capital advantage of some 240 basis points, lower cost of capital than a traditional real estate investor would have.
Hey, Bob, I'm sorry. Could I ask a quick question here, just to
Sure,
so I can
please just
understand?
jump in at any time.
All right, so if you go back a couple of slides, 'cause I want to make sure I'm kind of following I guess the
Ah,
timeline. Yeah. So on this fund, Fund One, there was a portion of the strategy that was the exit was to REITs, but then it's
right,
also
these
come
24 schools right here.
got it. And then but then there's also a portion that was sold to the municipal bond, was sold through the municipal bond exit. Is that correct?
That's correct. They were sold to wonderful foundations, and Wonderful financed that acquisition by raising tax-free municipal bonds. They've done 3 of those offerings so far.
So as I look at these return metrics, are those driven by kind of an outlier, or is it really, based upon the whole portfolio?
That's the whole portfolio.
Okay.
Our average investment of these 43 schools is just a shade under $10 million per school. They range from a low of 5 to a high of about 21. So there's not really a single outlier that drives these returns. It's a whole series of very solid hits. Of those 43 schools, I think 37 of them generated our target returns or greater. We had 6 that underperformed for one reason or another, but in aggregate across that whole portfolio, no, those returns that you see here on this page are driven by just consistent, solid execution across a diversified portfolio. In fact, diversified across 17 states in our first fund.
Got it. And then the other question I have to ask is, I see a lot of presentations and they're always very, very optimistic and things are great and hunky dory until they're not. And I can't think of like the pandemic, so I always like to ask like what was the pressure like on you guys during the pandemic? What did the cash flow look like? Was it affected or did it kind of just keep going?
I'm glad you asked the question because one of the things that we focus on both in this strategy and in all of our strategies is what I call counterparty risk. How reliable is your revenue stream from whoever pays the bills? We owned 43 schools through a major portion of the pandemic, and we had 0 late payments and 0 missed payments. Quite reliable, driven by the fact, as I mentioned earlier, that because the funding for the rent comes from state government, right, and is the number one spending priority for every state, schools were getting paid just like clockwork by state governments. And that capital, which flows into typically in our structure, flows into a lockbox, and we draw our rent straight out of that lockbox, was unimpeded during COVID. In fact, in many states, it was actually subsidized to facilitate the continuing operation of schools so that kids wouldn't be terribly affected, even though in some cases they were because distance learning wasn't great.
Okay, thanks.
Yep, you're quite welcome. Thank you for the questions. Keep them coming. Now, as I was starting to say, because of this attractive cost of capital advantage that a tax-free charity financing their acquisition with of schools with 100% debt and inexpensive tax-free debt. If I stop my story here, you would say to me, congratulations, your investors must be very happy because of this structure, and they were. But there are a couple of benefits in this structure that it was important to us also be part of the overall picture because we do recognize that when we rebuild a school, we are now a member of that underlying community. And we have to be sensitive to the needs of the community as we go along. That's why it was important for us that Wonderful Foundation has the mission that it does of owning education facilities for the benefit of children and the communities. But now those schools are owned by a public charity. And as a public charity, which simply has a 5-person volunteer board of directors, their fiscal operations are as follows. Every year they add up their revenue, which is just nothing more than rent on the buildings they own. They add up their expenses, which are simply principal and interest on the bonds. A municipal bond is typically 30 years in duration and is like a mortgage. It fully amortizes over the life of that bond. So they add up their revenue, they add up their expenses, and anything that's left over, they gift out to the underlying schools that they own as a rent rebate. So as a result, the schools are getting a little benefit every year in the form of a rent rebate that they can use for whatever they want. That's the little b benefit, as I call it. The big B benefit of this structure is that in order for Wonderful Foundation to maintain its tax-free status, when the bonds are fully paid off, the charity by contract is required to gift the underlying school back to the community or the operator of the school for free. So now when a mayor or a school board president or a charter school operator is looking at, well, how do I finance my facility needs? They consider issuing their own tax-free bond, and some do. But instead, we can come to them and say, well, you don't have to go through that 1 or 2 year process. I can start with a bulldozer tomorrow. I come in, I build buildings all the time. We've built $600 million of bridges, school buildings, post offices, et cetera, in the last 5 years in the worst inflationary environment of my career. And we're on time, on budget on all of those. So we can start tomorrow. We know how to do this. And yet we exit our investments after just a few years using the same exact mechanism a city would use, using tax-free municipal bonds, and do so in such a way where long-term the same outcome occurs. The city gets the school back. So if you look at this and you say, okay, how does this work school by school? Well, on average, we buy a school at an 8% cap rate. I'll show you some numbers in a moment of our current pipeline, but that's our average acquisition cap rate. Pretty attractive. For every dollar we invest in acquiring a school, we put another 40 cents in, typically in upgrading the school. As I mentioned with the case of the school in Fort Mojave, Arizona, every school needs an HVAC system, a technology package, a security perimeter, and from there, everyone is different. On average, as I mentioned a minute ago, our average school capital deployment is about $10 million. That upgrade capital goes in at about 9.25 to 9.5. We end up with 20-year leases, typically with 2 10-year extensions, with rent that is linked to inflation escalators. So after a few years of ownership, on average, we own a school for 4 years. We end up with an asset that's generating about 9.5%. And the public charity here can afford to pay us 6. Now that delta, 9.5 to 6, in many investment strategies would be referred to as cap rate arbitrage. I can buy at high cap rates and sell at low cap rates. That's not this. We're a taxable investment fund. Our investors are typically taxable investors. When I buy a school from a school building from a real estate owner, that's a taxable transaction. But the party to whom I am selling is a tax-free entity financed with tax-free debt. So this is really tax rate arbitrage. It's not something that comes and goes depending upon how hot the market is. It's structural in nature and permanent. And in other words, we are putting these hands in these school buildings, once we have finished our work, in the hands of a long-term owner where structurally it makes sense. We as private capital do what private capital should do. Come in, fix a problem, make sure everything's running well, and exit. And ultimately return the asset into the hands of the community. So it's a huge problem. Over 90,000 public schools, district schools as we refer to them, over 7,500 public charter schools, $420+ billion funding gap. There are very few people doing this. It requires that you understand state education regulations, state by state, funding regulations for education, state by state, Fortunately, we have over 30 people in our platform team here who eat, sleep, and breathe schools and understand all of this very well.
And that's the question I had, Bob. Sorry to interrupt you.
Oh,
Uh,
please.
I I know you're a smart guy, and the American Infrastructure Partners team, they're all smart people, but why haven't like larger institutions come into this, like the Blackstones of the world, for example?
It's a great question. I ask myself that question all the time, but I think it's largely driven by the fact that your average transaction is $10 million, Matt.
Uh,
This is not like I'm going to go rebuild JFK Airport and deploy $2 billion. You have to have the appetite and the ability and the interest in deploying, a reasonably healthy amount of capital. We're raising $500 million here in $10 million increments. And we have the capability of doing that. We did so very successfully with 43 schools, which we put to work over a 4 year period in our first fund. We built up all of those resources for sourcing, but it's not something where you can write a big check and get the results on a single big consolidated basis. You've got to do it city by city, city council by city council, intersection of Main and First Street, community by community across the country. But when we do it and we're buying assets, what that results in, and thank you for that question, Matt, it results in us ending up owning assets which we acquire at attractive cap rates and end up as a result with a fund generating yield. Our second fund, which we're currently raising, already owns 8 schools, as I'll show you in a minute, and we're already generating very attractive yield. But because of all of this, we are now today a fully integrated platform for investing. We've got the sourcing flow, we've got the team that does all of that, the team that underwrites, the team that manages construction, and a baked in path to liquidity for our investments after we've done our value added work. Here's the fund as it sits today, our second fund. We already own 8. I'll buy 2 more next week in Florida, spread across 6 states. We're already owning facilities in which over 5,000 children are being educated. The fund is already generating an 8.25% cash on cash yield. If you wrote a check to us for the fund today, you get your first distribution check the second week of August and every 90 days thereafter. We don't use a lot of leverage. Currently, we're only levered at 14%. Our target leverage in this strategy is 33%. So this is not a set of returns that are generated by a bunch of balance sheet gymnastics. On the contrary, it's true value added. Our first 8 schools we acquired at a very attractive cap rate, 9.6%, hence why we're generating a very attractive yield, and an average investment of $10 million. But it doesn't stop there. I have 18 schools ready to buy here over the next couple of months for $202 million. That's another 7,800 children. Again, with rents that increase at roughly the rate of inflation contractually. And we assume with every one of these schools that we're only going to own it for 4 years and then exit through the mechanisms I just talked about. This near-term pipeline, which is just a subset of a broader $1.6 billion pipeline, hence the massive need for this kind of activity in the United States. This near-term pipeline is at 8.5% acquisition cap rate. So the story continues. The execution continues. At some level, it's kind of boring because it's just doing the same thing, same team, same strategy, same thing we've been doing here now for 13 years. But this is a strategy that, in my opinion, needs to be executed on behalf of the children in this country and can do so at very attractive overall returns. So
I had
we're
a
raising.
I had a
Yes, sorry.
question. If you
Yeah,
go
please,
back,
Matt.
I had a question, and then we had a question from the audience. So if you go back, I think it was the slide before this, you said, you're not doing financial magic or financial gymnastics for these returns.
Right.
This is just value add. Can you just, you have developed a lot of real estate. Can you, this is really for me, can you kind of just drill down on that a little bit more about what you mean about you're not doing that? This is just purely value add kind of more straightforward stuff.
Sure. I mean, if look at, I'll use the exact numbers from the two schools we're about to buy in Florida next week. Um, those investments we have underwritten at the school level to a 20% overall return. That's based, half of that return comes from yield, from the rent that we acquire the schools at, 8%, plus a couple more points of increase in yield or increase in cash flow as we modernize the school, and that one has a modest upgrade package to it, but also the annual inflation escalators that we get on the rent on those buildings. So half your return is coming just from cash flow. Another 2 points comes from leverage. We do use a little leverage, all right? And the remaining 8 points come from the fact that we acquire the school as a taxable entity and sell it as a tax-free entity. That tax rate arbitrage that I mentioned earlier.
Okay.
So, which has a lot of value from a community's perspective, because that means private capital can quickly fix the problems they have, but they're not giving up long-term ownership of the buildings. And that, in the eyes of a school board president or a mayor or a charter school operator, is real value. You also said you had another question from the audience.
Yep. This participant, thank you for asking your question, said, obviously, this is their words, obviously a self-directed IRA is perfect for this. Any 1031 exchange opportunities for this investment?
We actually have some investors that are coming in through a 1031 exchange right now. You cannot take 1031 money and come directly into a fund. So we use a different structure in which participants or people who have 1031 capital, and it has to be relatively substantial, acquire a school that we help them identify. We manage it for them. And then after a tax year ends, it is dropped into the fund. It's often referred to euphemistically as a drop and swap. Or swap and drop, swap it into a school and then drop it into the fund. If people are interested in that, we can talk more with them or their tax advisors, very importantly. But it is something we've done both in the school fund and actually in our fund where we acquire post offices.
Nice. Okay. Thanks a lot, Bob, and thanks for that question,
Sure.
participant.
I want to point one other thing out, however. Investors are often faced with the opportunity of investing in a 10 or 12-year fund, particularly when you're doing things like infrastructure or essential government related assets like we have here today. This is a much shorter fund. It's a 4-year investment period and a 6-year total fund life. That may seem very short for what we do, but we put $369 million to work in 4 years in our first fund, $200 million in the last 14 months of that fund. We already have $100 million deployed here against a $500 million total fund deployment target. But with this structure, with a large, big pipeline of things to buy, like the stuff that you see represented here, with $1.6 billion pipeline and $200 million to acquire immediately, the fund has one very unique structure, which high net worth investors I find really appreciate. It's not a drawdown fund. If you, Matt, were to send me a commitment for $1 million today, I would send you a capital call next week for the full $1 million. That means we can put it to work immediately because we have more schools to buy. Like I said, I've got 2 more we're buying next week in Florida. We can vary the debt and equity component to bring more capital in through that structure. We just finished negotiation and have a handshake now on a school in the District of Columbia in DC. I really like that one because my counterparty there is not state government, but the federal government, which is kind of interesting and quite unique. But these needs are everywhere across the country. And as a result of that, we are getting inbound inquiry regularly. Most recently, we had a conversation with the mayor of a relatively large town in Pennsylvania, who's got hundreds of millions of dollars of needs across his elementary and high school portfolio, and has been rejected by his voters, his taxpayers or his voters, on his request for the ability to issue additional municipal bonds. So He's between a rock and a hard place, and when he heard about us, picked up the phone and called. We have that same story going in both Ohio and Kansas. So the need is huge. That's why you see a big pipeline and a near-term actionable pipeline. But if we're able to put capital to work immediately, generate yield immediately, that means the fund has no J curve as a result, which is something that investors find very attractive. So we're raising 500 million, as I was starting to say, 4-year investment period, 6-year total fund life, target return on the new fund of 18%. That's higher than our first fund because we expect to exit more of our schools through this unique path, selling them to public charities, which we have developed. Modest management fees, 75 basis points only on deployed capital. Why on deployed capital? Because we put all the money to work immediately. And the best way to wrap this conversation and this storytelling up, and maybe we'll take some more questions then, Matt, is to show you a couple examples. The school you see in front of you is a high school in Voss, North Carolina. It's a school it's a charter school and is dedicated to children who are interested in the performing arts. This school needed a new roof, which has already been installed in this picture, a new HVAC system, and most importantly, additional classroom capacity, which you see being added right here. In fact, that classroom capacity is being added while the extra children that are already in place that will occupy that classroom capacity are in these temporary classroom buildings that you see in this picture. We owned this one for a very short period of time, just 28 months. That's why the IRR on the asset is so high. You should ignore that. But even in 28 months, we still generated 2 times our money and exited this in the first of the municipal bond sales that we did to Wonderful Foundation. Jumping all the way across the country, here's one in the San Francisco Bay Area. A-Method is a K through 8 school. This school needed a lot of work. HVAC system, new facade on the building, needed to strip the walls in some places because mold had gotten in between the walls because of a leaking roof. We owned this one for a longer period of time, 51 months. Exited it in our second bond offering sale package of schools to Wonderful Foundations. And even though we owned it for over 4 years, we still generated almost 30% IRR on the asset on this particular investment. It's a great school. This is one of 3 charter school operators in California that receive a federal grant funding as part of a charter school initiative going all the way back to 2017. So very successful school that services a population in Richmond, California, not a great economic area of the San Francisco Bay Area. 100% of the children in this school are African American and Hispanic American. And the bulk of the kids in this school receive free lunch at the school because of their family income level. So they qualify for free lunch. And then finally, here's a school that's already in our second fund. Winter Haven, Florida is where we are now with this one. We've underwritten this investment to a 48-month hold, even though we've done the bulk of our work now. We acquired this school the middle of last summer. We cut the ribbon in January. This school is pretty unique. This is a school dedicated to children with autism. If you live in Winter Haven, Florida, and your child is somewhere on the autism spectrum, they're likely going to have the opportunity to send your child to this school in Winter Haven. The city called us because they had a facility dedicated to autistic kids that was out of capacity and needed to double the size of their operation or their capacity. We found this building you see pictured here, which was an old medical office building, acquired it, and in just a very short period of time modernized it. In fact, the headmaster called us here about 3 weeks ago. And even though we went from 200 child to 400 child capacity in this building, they're already out of capacity again. And so we're now talking about adding some more classrooms on the back of the building. It's one of the interesting things we see. We modernize a building, and it becomes the most attractive school in a community for families to send their child to. It also becomes the most attractive place for teachers to work. And so when you get a modern facility and the best teachers in town working in that facility, we see grade levels start to improve. We've seen grade levels that for children in our schools improve quite dramatically. And that's one of the things that I really enjoy about this strategy. We are making a difference with the kids while also generating very attractive returns. So it's the same team, same strategy as we've been doing since all the way back in 2014 when we bought our first school. Um, Same execution path and same path to liquidity to exit these investments, all baked into one integrated investment platform. So thank you, everybody, for listening to this. Matt, any other questions that folks have out there? Please.
Yep. So I think the theme of these questions is mostly around, risk. What can go wrong?
Sure.
So first question is, what can go wrong? What are the one or two things that you worry about most as as the operator here, I guess? And then second is, how does a change in government affect this strategy, or how does that put your strategy at risk?
Sure. Um, Good questions. Let's start with the what can go wrong operationally. The biggest thing when we underwrite a school, we will underwrite the community looking for stability or growth in student age, in school age population, children, right? And making sure that we have a growing population base. We'll look at things like diversity of employer base in the community. We also underwrite the school operations themselves. Has the school been operating profitably for at least 3 years? As an example, does the school have a good track record of improving grade performance on the part of children? The school operator I'm talking about now. And then, of course, we'll underwrite the building. There's a whole module on how we underwrite a school that's available for people who are interested in our electronic data room. But the single biggest thing that I worry about is attendance at the school. In fact, recognizing that problem, when we began our strategy back a dozen years ago or more, we created a little internal consulting service inside of our operating team, which we call euphemistically referred to as kids to fill your classroom. When that service gets deployed at a school, on average, we see attendance in the school increase by about 22%. So it has a real impact in helping the school develop a brand, developing a marketing campaign, get on social media, um, uh, develop a whole program for everything from how do you run an open house, right, to how do you publicize yourself in the local community. One of the things that we have done as we have begun executing on Fund 2 is the cost to a school of that is very modest for a year of that capability or that service. And so we've actually included that 1 year of that capability in the underwriting of a school. So now when we buy a school, we go to the operator and we say, here, you have this service available to you for free for a year. Let's get the school off on the right foot. But we created that exactly because of the question that you asked, Matt. It's the single biggest thing I worry about. We want to see stable to growing population in the school. And that's a lot of those factors I mentioned, nature of the community structure, nature of the school operations, all are around that issue.
I'm certain this is something that gets touched on in underwriting, but is there sort of a certain rate of student enrollment decline which will be a deal breaker for a school where there's basically too much downward pressure that you foresee, or can you talk a little bit about that?
Sure. And I want to come back to your question of change in government or administration
Sure,
in a
sure.
minute as well. But remember that about 80% of the cost structure of a school is variable. It's teacher salaries. And so if a school starts to shrink in population, they just reduce teacher headcount. That's lumpy. And so, the real answer to your question is about 18 to 20% before we see a school start to have to cut corners in terms of the quality of education. But it's one of the reasons why we created this capability of enrollment marketing. And as I said before, one of the magical kind of virtuous cycles we see when we modernize a school is it becomes the bright, shiny object in the community, the newly modern school with all the latest technology. And that's when you get the best teachers there. And those two things in combination tend to lead to exactly the opposite, which is more people wanting to send their children to that school. As far as change in administration, no, not really. We work with both charter school operators and public district schools. It's easier for us to work with charter school operators because the decision-making process is much more expeditious. Um, but you know what, there's a lot of noise you hear about charter schools, public charter schools across the country, but charter schools as a type of public education were created in the Clinton administration. It actually is the product of a Democratic administration, and has been growing very rapidly. When we first started this strategy, we were working initially mainly with charter schools around the country. And at the time, about 6% of children were being educated in charters. Today, about 11% are. So the flexibility that operators have under a charter set of regulations versus a school district set of regulations has resulted in better quality, generally, not always, but generally delivery of better quality education for kids. Most importantly, from our vantage point, we see great grade performance on schools once we modernize the building. And that tends to be a driver of inbound student population, more kids wanting to attend, more families wanting their children to attend a school, is when the kids are getting a good education at the place.
Nice. Thank you for answering that. We have a question from the audience, and so this is in relation to one of the examples you showed. It
Sure.
says, I see that there is a 3% annual lease escalator in this school. Is this true of all schools? And does that mean my yield will go up, like in this inflationary environment?
Yeah, good question. Let me answer your question both with historic data and then with the details in the portfolio. In our first fund, yield on the fund started at 8% and grew to 10 over the life of the fund. In our new fund, our first distribution was at 8. It's now 8.25. We do fully expect that you should see your yield go up over time as a result of that. Not all schools have exactly 3%. It's all contractual and every lease is different. Um, we have one school that we are underwriting to right now that has flat rent for 5 years. And so, not surprisingly, we're discounting the upfront purchase to account for that in our proposal to the current building owner. So every circumstance is different, but that 3% number that you see plugged in here on this sheet has been the average over both the life of our first fund and certainly all the stuff that's in our pipeline today.
Okay. Awesome. I don't have any more questions, and we're kind of at that sweet spot where it's probably good to wrap things up.
Yep.
Um, do you have any contact information that you would like to share? What's the best way to reach you if someone has any questions?
We don't have it on this slide, and I wish I had stuck that at the bottom. People can reach out to us. Our web address is www.american-infrastructure.com. My personal mobile phone number, if you want that, is 650-619-1337. I'm always happy to talk to investors or people who are interested in what we're doing. 650-619-1337. My web address is bhellman, BHELLMAN, at american-infrastructure.com. Or I think if they just reach out to you, Matt, you can probably send them my direction as well, if I'm not mistaken.
Absolutely. So I'm gonna throw that in the chat really quickly. Um, bear with me. You can reach Bob at.
I should have
Okay.
put that at the bottom of the slides.
No
Um,
problem. I'm proving a stereotype here that I can't do two things at once. You can't. All right.
Leaving your
There we go.
capabilities. There you go.
Perfect. Okay. Well, thanks very much, everyone, for joining today's webinar. Bob, really, really great presentation. Um, Full disclosure to everyone, I do always do an introductory call with anyone who presents on the webinar, and so when I was talking to Bob and learning more about American Infrastructure Partners, I thought this was going to be a really, really interesting one. So forgive me for nerding out a little bit as I asked the questions, and thank you for those who did ask the questions. Bob, any final comments you'd like to share before we close?
I would just hope that people would find this as a compelling way to both generate great returns while also feeling very good about what the impact is that your capital can have on communities across the country. So we certainly would hope that you would join us in helping make a difference in a whole bunch of kids' lives around the United States. And thank you very much for everybody for listening.
Great. So you can reach Bob at the contact information that I shared. You'll receive a recording of this. And as always, thanks very much for joining today and have a great week, and we'll see you on the next one. Goodbye, everyone.
Thanks, folks at Camaplan. Appreciate it, Matt.
You bet.